I'm Hadi Elzayn. This is Differentially Private Call Auctions and Market Impact, joint work with Emily Diana, Michael Kearns, Aaron Roth, Saeed Sharifi-Malvajerdi, and Juba Ziani. Markets today are increasingly systematized and algorithmatized. Participants can react to market conditions with extreme speed. Whenever a trade is made, some information is leaked. The fact that some participant is willing to buy or sell at a given price provides some signal of the value and tends to move the market in the direction that is less profitable for the willing trader. This is market impact. There's a costly and profitable arms race of traders developing strategies that mask their trades or get in front of other traders. At the heart of them, they're all trying to prevent or exploit this market impact. I've put up a bunch of fun terms up there you can look up if you're interested. But suffice it to say that a lot of very smart people are working on these strategies and find them extremely valuable. A very simple example is iceberg orders. Rather than submit the entire order and reveal a large demand or supply, an algo trader might instead break up their order into small pieces so that only a small amount of their total trade is visible at any one time. And if an opponent notices, they might infer unseen demand and exploit it. Just to give you a flavor of the stakes, if not the strategies, in 2010, Spread Networks happily invested $300 million to dig a new tunnel for fiber optic cables between Chicago and New York, which saved 3 milliseconds on the communication between the exchanges. Now, as far as these trading strategies go, they do work to some extent, but they're all ad hoc. One trader devises a clever way to mask their order, then another finds some way to extract signal and move against them, so the original trader changes their strategy, and so on. And the result is an extremely complex market, with much of the so-called value being generated not really about fundamentals, but zero-sum billion-dollar scrapes for pieces of the pie. Now, we can interpret many of these strategies as an attempt to protect privacy of information or learn that information from others, where the information is related to the valuation of the participant or perhaps the status of the trade that they're making. So if we had a market that just preserved participants' privacy, we could do away with this arms race. Wouldn't it be better, if maybe less profitable for some, to have a private, simpler market? So the animating question of this work is, can and how can we achieve privacy in a market setting without sacrificing simplicity? We study a subset of these markets called call auctions. Now, informally, a call auction is a two-sided auction where buyers and sellers both submit bids. Buyers for the most they would pay, sellers for the least they would sell for, and a single price is chosen for everyone who trades. The purpose is to allocate the goods to those who most value them, and also often to foster price discovery. Again, these auctions are a subset of the overall market, but they're fairly widely used. So for example, 7% of all the New York Stock Exchange's volume comes just from closing call auctions. So our goal is to design a private call auction. By this, we mean something that performs the function of a call auction, allocates goods between buyers and sellers at a uniform and meaningful price, with the following properties. We want provable, gracefully degrading mathematical guarantees of privacy. We want to clear as many shares as possible and still allow for price discovery. We want the cost of the mechanism to be low. In our case, this cost is measured by the net position it may take on in the security itself. And finally, we want the mechanism to be simple for participants, hopefully incentive compatible, and ideally to look something like the call auction we know and love. So for the rest of the talk, we'll start off by discussing our modeling framework, and in particular, the standard call auction. Then we'll move on to how we conceptualize privacy. After that, we'll have the ingredients to describe our mechanism. Then we'll discuss the theoretical properties and results and how it meets our goals. And finally, we'll briefly discuss performance in practice. So to make sure we're all on the same page, let's walk through what an example call auction mechanism might look like. We have some sellers and buyers that want to trade a single unit of the security or good, and they submit their limit prices. These might look something like the columns of numbers and types on the left. Then we can count the number of people willing to sell at each price and buy at each price. So for example, in this example on the left, 4 buyers are willing to pay up to $1, 3 are willing to pay up to $2, 1 is willing to pay up to $5. For sellers, 1 seller is willing to sell for at least $2, 3 are willing to sell for at least $3, and 4 are willing to sell for at least $7. We can plot the number of buyers and sellers willing to trade at each possible price. An example of what that'll look like is on the plot on the right. And this particular plot won't exactly match the columns on the left due to the space constraints, but that gives you an idea of what it should look like. And you might find that this picture reminds you of supply and demand curves, and that's not a coincidence. So for any transaction, we need a buyer and a seller. So the number of shares that clear, that is trade, is just the minimum of the number of buyers and number of sellers willing to trade at that price. Thus, we can plot the shares cleared as a function of price via the minimum of the seller and the buyer curves. And I've highlighted this in green. And then we can just read off the maximizing price as the price that maximizes the minimum of sellers and buyers willing to trade. Now, in general, this price may not be unique. We'll refer to S and P as the number of sellers and buyers in a trade, and we'll use star to designate these quantities when we clear the maximum shares traded. So P star maximizes shares cleared, and S star equals B star, and that number is opt, where opt is short for optimal. Now, what do we mean by privacy? Many of you may be familiar with the standard notion of epsilon delta differential privacy, so I won't spend too much time here, but briefly, intuitively, a mechanism is differentially private if its output distribution doesn't change very much when we slightly change its input. So formally, we say that under two neighboring input databases where neighboring means differing in a single element, the probability that the output falls into any set can only differ across these inputs by a small multiplicative and additive factor. And for us, these databases will be lists of participant evaluations. So a natural first attempt is to directly use this notion of privacy. However, this doesn't quite work for our purposes. If we apply it just to the chosen price and then proceed with the allocation as normal, we end up leaking information. In particular, a coalition of agents could use the fact that each transaction has to have a seller and a buyer to learn the allocation and so evaluation of a participant not in that coalition. If we apply it to price and allocation instead, we can avoid that scenario, but at the cost that your allocation not be sensitive to your valuation. And remember, since we're ultimately trying to allocate the security to those that value it the most, this is also not a great solution. It turns out that there's a related, subtly different, but intuitively similar notion called joint differential privacy that will work for our purposes. Joint differential privacy makes sense in settings where the mechanism produces output for each element in its input. So allocation problems are a natural fit. Intuitively, it promises that almost nothing can be learned about your input, even if others collude with each other to pool their information. Formally, it looks like the definition of differential privacy that we had before, but with that negative I. That's just saying that rather than ask that the mechanism's output not change when an element I is changed at all, not change too much when an element I is changed, instead I'm asking that the mechanism's output distribution over all but that ith element's output not change much. That means that the non-I people, the participants other than I, can't learn much about I's input based on what they jointly observe. So now we can talk about our mechanism. So we actually have two and select privately between them, but I'll focus here on one. The mechanism has 4 steps. In the first step, buyers and sellers submit their limit prices. In the second step, we use these limit prices as before to calculate how many shares can be cleared at each possible price. Then, using the exponential mechanism, we randomly pick a price P tilde, and if you're unfamiliar with the exponential mechanism, it's just basically selecting an option randomly by putting exponentially more weight on better options. In the third step, we define S of P tilde and B of P tilde to be the number of sellers and buyers, respectively, willing to trade at price P tilde, and calculate these accordingly. But we can't just use the number of sellers and buyers that would be willing to participate at P tilde for the same reasons that we talked about before. So instead, we use the Laplace mechanism. In other words, we add Laplace noise to get randomized estimates of S of P tilde and B of P tilde, which we call S hat and B hat. Finally, the fourth step is to pick the actual sellers and buyers that will participate among those willing to do so at price P tilde. And to do this, we flip metaphorical coins whose probabilities are calibrated as a function of S hat and B hat. And note that since these are randomized, the mechanism often will have to take a small net position in the security. So now briefly, I put up a simplified version of the guarantees our mechanism enjoys. So first of all, the mechanism is epsilon 0 joint differentially private. It also performs well relative to opt. With high probability, it loses a square root of opt term, which becomes small relative to opt as opt grows large, and also a linear 1 over epsilon term, which we show is unavoidable. Finally, with high probability, the necessary inventory will be small relative to opt. though again, you'll pay a linear 1/epsilon factor. And our alternative mechanism is very similar in terms of most of the mechanics, and it has similar but generally incomparable guarantees. So again, I've put up the simplified guarantees here. And just looking at the guarantees, the difference is that we lose a log n factor rather than a square root of opt. And similarly, pay a log n rather than square root of opt for inventory. So depending on whether square root of opt is a lot smaller than log n over epsilon or not, you want to use the first mechanism over the other, otherwise the second. And as I mentioned, we have a meta algorithm that privately picks which mechanism to use, and so always gets the better of the two guarantees. Now, our guarantees are essentially optimal, as I said before, in that the 1/epsilon term is necessary. We show that any mechanism that provides epsilon delta differential privacy with respect to the price must suffer a loss of 1/epsilon in some examples. And this is necessary to be joint differentially private over the whole process. So the proof idea is simple, if a little bit involved. We basically just construct a family of examples whose members differ by just a couple of changes each, yet the first and last can be made arbitrarily far apart. So I'm kind of animating that on these slides. And by differential privacy, the output distributions can't change across these examples. I mean, can't change too much from one to the other. So by carefully calibrating this, you can show that if you do well at one extreme, you necessarily do poorly with some probability at the other. Now, our mechanism has nice incentive properties that we would hope for. It's individually rational, since participants only trade if the price chosen is one they're willing to trade at. It's also approximately incentive compatible. And note that this is not true in the standard call auction, because even a single person misreporting could change the price a lot. And finally, I'll just note here that while we mostly assume that agents want to trade exactly one share, in the main body of our work, our incentive compatibility guarantees, as well as privacy guarantees, can be extended linearly to the case where agents control multiple shares. Now, our results are fairly nice in theory, but how do we do in practice? So we're going to test the performance of our mechanism under various choices of epsilon to simulate how tight our guarantees are under nice practical conditions, since the theory guarantees are our worst case. Now, since valuation data is not easy to come by, we use simulation, and we draw 5,000 buyers and seller valuations from normal distributions with a reasonable distance apart. For now, we assume that the bidders bid their true values, which is sensible since the auction is approximately truthful, and we compare to the truthful optimal. So I have two plots here. On the left is shares cleared relative to the optimal, and on the right is inventory taken on relative to the optimal. On both plots, the x-axis is epsilon, and recall that smaller epsilon means more privacy. Theory is in orange, and our simulated results are in blue. So there's two important takeaways here. First, notice that there's a large gap between theory and practice, at least on this relatively nice example. Practice seems to do a lot better than theory. And second, note that while, for extremely private levels of epsilon, theory gives bad or even vacuous guarantees, just giving up a little bit of privacy allows for a lot better performance. This is perhaps even more pronounced for practice than for theory. And in particular, at epsilon equals 0.05, you're getting close to opt shares and paying almost nothing in inventory on a relative basis. Now, we ask how our mechanism might perform in a repeated setting. We assume that agent valuations are drawn once and that the mechanism is repeated for many rounds, and agents are not fully strategic but learned a bit over time. The idea is to capture both the hypothetical pre-auctions that the New York Stock Exchange and NASDAQ hold before they run their opening auctions. So they say, like, if the auction were held right now, such and such would be the price and shares cleared, and participants update, and then they resubmit orders, and this repeats, and so on. And we also want to capture a setting where agents might not know or trust that the mechanism is really incentive compatible. And so rather than mechanistically model traders, we want a notion of learning that's generally robust and captures reasonable behavior. So one family of algorithms you may know is called no regret. And these algorithms give good adversarial guarantees relative to the best fixed action in hindsight. We assume that agents use modified exponential weights under the assumption that price doesn't greatly depend on their own bid. And note, this is like saying that agents are small. Again, it's a naive assumption under the standard call auction, but it's approximately true in our mechanism by differential privacy. By small, I mean in terms of impact on the price, not just in terms of size, because remember again that we are assuming that each agent is only wanting to trade one share in the main body of the work. Now, first of all, we show that if all agents use modified exponential weights, the shares cleared will converge to the optimal. That is the same as if agents had just bid their true value. And this result may be of independent interest. But in particular for our mechanism, we show that a probabilistic convergence will also occur, in the sense that after long enough, the shares cleared will be close to opt with high probability, where close will be given by some theoretical guarantees as above. And so let's look at the results to see how this might look in practice. Again, we draw buyer and seller valuations from normal distributions a reasonable distance apart. Here, each plot has the number of shares cleared on the y-axis and the number of rounds played on the x-axis. We get less private moving from the leftmost plot to the rightmost plot. So notice that first of all, in each of the plots, the trajectories move from low to high, never crossing the turquoise line, of course, since it's opt, and the speed of increase is very large at first and then tapers off. Notice also that the trajectories never quite settle down. This is that probabilistic convergence. After long enough, each round will be above some lower threshold guaranteed by theory with high probability. But the exact amount of shares cleared will be random. And notice that the noisiness increases with privacy, that is, increases with smaller epsilon, which is exactly what we would expect, because the more privacy we want, the more noise we have to add. Now, just to recap, in this work, we design a joint differentially private call auction that's guaranteed to be epsilon 0 joint DP. We achieve good performance in terms of shares cleared. We take on only a small amount of inventory. And we simulate our empirical performance to show that we do relatively well. We do well relative to theory, even better than theory. We prove that our mechanism will converge to the optimal shares cleared when agents are using some family of no-regret learning algorithms. And we demonstrate that this happens reasonably quick in practice. So thanks very much. And if you can't wait for the camera-ready copy, you can go to archive and check out the preprint. Thank you.